Afternoon, good evening, wherever you are in the world. My name is Stephen Place. I'm the founder and head trader at investingwithoptions.com. The markets are finishing up right now. The tech is running, and I just got some really awesome information for you with respect to an indicator that I developed a couple years ago. If you trade options, this is important for you. If you sell options, this is more important for you. If you sell credit spreads, or if you try and find a way to develop an edge even further, then I have something for you. And honestly, this thing's free. You can go on TradingView. You can get it. If you email me, it's available on Thinkorswim. I think MetaTrader, and we're pushing it to NinjaTrader as well because I'm transferring over to NinjaTrader. So today, we're going to use TradingView. And what you can do, you can search for it if you want in the public area. And you want to search for turning point indicator. And this helps me identify profitable turning points in the market. And let's just change the plot to yellow. Okay, cool. So what does this do? This shows us the rate of change of an instrument, and it also shows us the context of that rate of change. Because as an example right now, you say, man, the NASDAQ's running a lot. It's not really overbought statistically. It depends on your time frame and it depends on your context. What's good for this now is it tells you the precedent in the past, and it tells you the statistical odds of certain price levels getting hit. Jennifer's asking about Tasty Trade. No, it's not on Tasty Trade. If you want to code it, it is a rate of change indicator plus volatility bands. So we're looking at standard deviations. So when we say, for example, if we say the NASDAQ is overbought, you say overbought with respect to what time frame? Because the market has energy, all right? And energy is shown through liquidity. When the market has very low energy, it means this market is range bound and we're seeing compression and volatility. When the market is expanding in trend or expanding in volatility, it's spending lots of energy. So when we think about market cycles, we have markup, distribution, markdown, accumulation. All of those kinds of things spend a certain amount of energy. It spends a certain amount of liquidity. So what we can tell, as an example right now, is we can look at, let's just say a 10-day window. So 10 days is going to be 2 weeks. And we can say right now for the NASDAQ 100 index, it's currently up 7.5% over a 10-day time frame. And that's a good amount. That's a pretty good rally. And what we can do here is then we can throw on a line and we can say, what kind of precedent do we have in the past? In what context does that make sense? Are we seeing massive parabolic movement, or are we seeing just a normal grinding market higher? And within the context of, let's just say, the crash back in March and April, what tends to happen with this indicator is you will have very large upside readings after a hard sell-off. All right, and that makes sense. It's a rubber band, right? If you see 20% to the downside, odds are you can see 10% to the upside pretty quickly. So with the NASDAQ 100 hitting all-time highs and seeing 7.5% within a 10-day window, that seems to be a pretty good amount, okay? The other cool thing you can do with this is you can say, given normal market conditions, and so during crashes, this won't work as well, but given normal market conditions, and you can keep zooming out and you can say, okay, on average, the downside for the NASDAQ within a 10-day window is about 5 to 7%. And that's useful because if you sell credit spreads, especially if you sell weekly credit spreads or shorter duration credit spreads, strike selection is huge, right? If you sell, let's just say where are we trading? The 296. So if you sell something like the 280, 275 bull put spread, and then the market closes at 274, you're at a full loss. But if you sell the 275, 270 bull put spread and we close at 274, you're probably at break even. So finding what strikes to choose with your credit spreads and with your iron condors and where to take profits is crucially important. And that's what this indicator can give you. All right. So if you want, just let me know of some stocks that you'd like to see with this, and I'll give you some ideas of how this can work. One thing that I'd like to do really quick is we're going to pull up a brand new spreadsheet, and I'm going to give you a trade example in NVIDIA, because I am looking to sell call credit spreads in NVIDIA, right? The stock's up a lot. It's parabolic. One of the ways that we can view this is instead of looking at a one-day indicator, we look at a one-week indicator. And we can say, hey, you know what? Over the past, what's this low? Okay, so from March 16th all the way to now, that's from 200 to 500 over the course of about 20 weeks, so about half a year. That seems like a lot. And we can now ask ourselves, because NVIDIA's had massive runs in the past, what kinds of upside have we seen in the past? What kind of context can we give to this? So what we can do is we can adjust this. Instead of 10 weeks, we'll look at 20 weeks. And as you can tell, we're up over 80% within a 20-week window. A couple weeks ago, we were up 110% over a 20-week window. Is that a lot? We've seen it before, right? We can think about the tech bubble in 1999, but we can go back to the big move it had in 2010, 2011. We can look at the big move it had in 2017. But we're close. We're close to some sort of shorter term odds of reversion are very high, shorter term top, simply because a lot of energy has been expended. So what I'm looking for now is saying, okay, if I want to sell some credit spreads, for those of you that don't know much about options, selling a credit spread, a call credit spread, is where you sell a call and then you buy a call on higher strikes. If the underlying stock does not see movement above your short option, then you're going to make money. If it sees it below, if it goes further than that, you're going to lose money. That's the basic bet. So we've got about 3 weeks left to options expiration on the September monthly options. So what we can do is we can look at the most recent pivot level to the downside, which was August 11th. And what I want to do here is just say 8/11/20. And then the September options expiration is going to be 9/16/20. Okay. And all we want to do is subtract those two. So Sep 16 minus Aug 11 is going to be 36. All right. So this is some pretty cool magic. Just pay attention really quick. What we're doing is counting the days between the most recent pivot low and September options expiration. And what we can use is the past price action and say, what kind of precedent do we have? And what can I get away with respect to selling options? What kind of call credit spread will I get for a very, very good price that can give me an amazing edge? All right. So what we can do is we can change the turning point indicator to 36 days. And then we can go and we can look historically. And we can say, all right, from the March lows, NVIDIA rallied 50%. And that kind of makes sense, but we're hitting new all-time highs. So we want to look at other instances in which the stock has rallied to all-time highs. And that's going to be around this cluster between September and October. And all you have to do is you can either look at the volatility bands, but they're kind of pinching in right now, or you can draw a line just to give you a rough idea of where you should be looking. So we'll draw another horizontal line off of the most recent highs, which was 33% over a 36-day window. And then you can look and you can say, what kind of upside can we reasonably expect in NVIDIA? There are certain instances in which it sees massive movement around an earnings event. There's certain instances in which it will see large upside moves in response to a very large sell-off. But overall, there's not much here other than maybe, around 50%. Okay, so what we can do then is we can say, well, what was the low on August 11th? And so that's going to be right around, where's the low on this? 431.83. All right. And because it's NVIDIA, we're dealing with such large numbers, right? We're dealing with 50% higher. What's that? That's going to be 647. Okay. What I'm looking at right now for my trade setups is I am looking to sell options. I'm looking to sell call spreads in the 600 strike range. The last time I looked at this, and I put it on Twitter, so I'll just double check it really quick, is that the 20 delta short option on NVIDIA was in the 600s. Just give me 1 second. Where did it go? I see your stock charts. I'll get to it in just a second. Latest. All right, so currently the 605 strike is the 20 delta call option on September. That means the implied odds are around 20% that the options are going to expire worthless. That's the one I'm focused on, right? The odds right now of we've already gone up 33% within the context of a 36-day window off of those recent lows. I also like looking about 50% higher from that and saying what kind of probabilities are currently priced in the options market and what are the implied odds in our turning point indicator, okay? I know I'm talking fast because I know we're going to kind of rip through this really quick. Okay, Nishant's got a really great example in Tesla, right? Everyone is focusing on Tesla. There's a lot going on right here. So one thing we can do, Tesla had a nice little squeeze in July, and then it went sideways, and then it had a squeeze from, and these numbers don't make sense to me because it just did a split from 275 to 497, right? That's not the real answer. It was trading at over $2,000 a share last week, and I'm still in pre-split prices. That's why I'm like, there's no way these numbers are right. But you can look at this rally, and you can say, all right, this looks like a lot. What has Tesla done in the past? And can we put some context on it in the future? Because trying to short Tesla has been and continues to be kind of a widowmaker trade. There's some other mechanics going on that are a little bit more advanced with respect to how options are trading and how convexity is happening and how momentum is just rolling over any short calls. That's kind of beyond the scope of what I want to talk about. It's on my YouTube. If you want to go on YouTube and look up investing with options, the most recent video we did, do it after all this summit and everything. If you're watching this recording, you can check it out. But what we can do, it's very simple. We can say, all right, from this breakout, how far have we moved and what kind of context do we have? And it just so happens that the breakout in Tesla coincides with the same pivot low that we saw in NVIDIA, which was going to be August 11th. All right, a lot of these high beta tech stocks started to all move in concert with one another for certain reasons, momentum-based reasons. But we can look at this and we could say, all right, what kind of move have we seen over the past 36 days? What you can see is that the most recent peak from that was actually back on August 18th because the sampling window includes the move from 200. Okay, so we've actually seen stronger moves relative to this. What we can then do is drill down and say, all right, let's just think about this from a 1 week time frame because it's starting to go a little bit parabolic, right? So let's just take a look at 5 days. Remember, 5 days is one trading week. And what we've seen in the past, that's not on there anymore. All my indicators are messed up because of the split. What we've seen in the past, and with Tesla, the past includes 3 major upside pivots. The first one was in 2013. The second one was early 2020. The third one is right now. So to say Tesla is overbought, we've seen it get more overbought than this on a percentage basis, right? We've seen in a 5-day window, Tesla go up 50%. So it's very difficult to make the case for aggressive short exposure when we've seen precedent before with the stock moving aggressively higher like it has, okay? Of course, things can change as companies get larger and the market capitalization, it becomes larger and there is a change in the characteristics of the liquidity in the stock. Then that can kind of dampen the expected percentage returns, but this is still a good place to put some context on this kind of move. So does it make sense to get short Tesla? Maybe. You may want to be a little bit more patient and wait for that second or third push when we see the TPI get into 30 to 40%. Into that area, okay? Mike is asking, what is your Twitter name? Yeah, I'll just put it on. That's to all panelists. We want all panelists and attendees. So you can do that. If you want to follow me on there, that's where I spend most of my time. Some other cool things that you can do with the turning point indicator is, I'm pretty sure we can set this up, instead of looking at, so this is the secret sauce. Instead of looking at the turning point indicator as a function of time, we look at it as a function of range. So what we can do is we'll take a look at the cues, and the first thing we want to do is we want to look at the average true range. And I normally do this inside of Thinkorswim right now, but right now the average true range is right around 4. All right, so what we can do is we can divide 4 by 10, and then instead of looking at a time chart, we're going to look at a range-based chart. I'm pretty sure we can set this up. Okay. I think I got this right. You can take, and instead of looking at a 5-period TPI, look at a 10-period TPI. The ideal scenario here is you figure out the average true range of the asset you're looking at. So the expected daily movement, and then you divide that by 10. All right, so if the NASDAQ is moving 4 points a day, you want to set your range to 40 cents. And then you set the turning point indicator to 10. Okay, this will tell you in the very short term how much energy is being spent. And this is an incredibly powerful reversal trading system. So what you're looking to do here, and you can trade this long or short, but we'll focus a little bit on the long, is you want to see the TPI get underneath the second standard deviation line. So that's the lower green line. And that's going to be the place to start looking for long reversals. What you're looking for in this case is a push above the previous bar's high. All right, so you're not knife catching, you're waiting for confirmation of reversals. Okay, so if, for example, if you look at, this is in the cues, if you look at the 31st of August, right, we made a pivot low at 293.20. It got beneath the second standard deviation line right here. You wait for a push above that high. I'm going to try and mark this chart up a little bit. Where's my boxes? We'll just do it right here. Okay, so TPI triggered right here on that one right there. If you see a move above that previous bar's high, then that's your long, that is your long entry point for a long reversal trade. For a short reversal trade, what you're looking for is a push below the previous bar's low if the turning point indicator gets above the second standard deviation line. Okay, so you can end up trading multiple times on the same instrument using these reversal patterns. So why does this work? Why does this work so well is because the average daily range gives you an idea of the maximum expected energy that can be spent in a single day. But it's never, well, it's rarely all in a straight line. We do have trending days, but those trending days don't really provide reversal signals because we don't get confirmation of reversals into those, either to the long or short side. Normally what happens is that a certain amount of energy gets spent in the market, and then we see reversion and we see a pullback for traders and investors to reload within the context of the longer term trend. Okay, so what I want to do really quick is just recap that kind of idea. And I just want to make sure, because it's looking at a 10 range bar. And if you wanted to do this for a swing, you could also use longer dated ranges, and they should give you pretty good entry points both to the long and short side. Okay, and that's one of the beauties that I discovered over the past year and a half that the turning point indicator does so well. Instead of looking at a time series on a chart, we're looking at a range series. That way it already normalizes for some of the volatility, and that is when we can see where most of the energy is spent and where we can go from there. One other thing that you can consider, and we'll just go back to normal charts, and I know we're ripping through this really quick. Let's say, for example, let's say you own, let's just pick a tech stock. Let's say you own Amazon. And let's say you nailed it and you bought back at 2000 and the stock's currently trading at 34.73. And right now, the way if we have time, I can go on the riff that I went on earlier, because that's what I've been focusing on this entire week and over the weekend, how there's a massive convexity squeeze in tech. But what you can do is, if you own stock, you can anticipate where the turning point will be, and you can sell calls against it, right? So if we look at, we've got around, let's just say 2 weeks, we'll say 3 weeks to options expiration. So that's going to be a 15-day turning point indicator. What you can then do is you can look at this and you can say, all right, within this 15-day window, what kind of upside expectations do we have for Amazon? And right now I'm just eyeballing this and I'm seeing around 15 to 16% as sort of the upside cap in terms of energy. So what you can then do is you can figure out what the call option is 15% higher from this price, and then you sell that call, because that gives you a certain amount of income by selling that call. It also allows you to try your best to keep hold of your stock, because the ideal scenario when you do covered calls is you want the call to expire worthless and you don't want to get called away and you just want to hold the stock. The ideal scenario is to have the stock trade just underneath your short call going into options expiration. All right, so you can do that. You can say, all right, what kind of premium is available on Amazon, 15 percentage points higher on the September calls, and there's going to be a lot because the implied volatility is exploding right now. And what kind of odds do we have associated with that? Because odds are there's going to be much, much more premium, especially right now, the way the market's trading, there's going to be much more premium available on those calls than what is going to happen in the near term. Okay. Mike is asking, are you choosing 15% because that's on your rate of change vertical line? So what I'm looking at, and there's more quantitative ways to do this, but I am looking at basically the range of these spikes. And most of these spikes higher are within the 15 to 26 percentage point range. If we wanted to be a little bit more statistically prudent, the way the TPI is initially set up, it's a sample length of 10, and then the standard deviation is over a 60-day window. You can increase that to about 120, and that should widen out your bars, or that should widen out your standard deviation. So you can then look at the second standard deviation to the long side and to the short side to give you an idea of, the way that this works is that the turning point indicator, if you turn it on its head, will look like a bell curve. Most of the changes in an individual stock will trade within a certain bell curve. For Amazon, it's probably going to be within this window around 5%. And then the standard deviation, as you can tell from this upper line, the second standard deviation is 17.25. The lower standard deviation is minus 17.25. Okay, what that means is within this sampling window, what's 2%? About 95% of all of the samples will be between plus and minus 17%. So if you expect Amazon to trade normally statistically, then if you own the stock, you can sell calls that are about 15 to 17% higher. If you want to own the stock, you can sell puts that are about 15 to 17% lower. Okay, that's another thing that you can do with this, where you can look at, for example, the NASDAQ, and we can keep it on a 15-day window. And we can ask ourselves the question, what is a statistically normal pullback over a 3-week period for the NASDAQ? You will get some out of sample data, right? A crash like we had in March will always look more oversold. And that's normal. If you go outside of that, then you can kind of eyeball this and you can say, okay, if we don't include that March crash, the normal pullback is around 8 to 12 percentage points over a 3-week window. And here's where the math can get really fun. Let's say we do see a rug pull in NASDAQ stocks. Let's say we see a 5% pullback over just a 1-week window. Well, if you know that over a 3-week window, we tend to pull back, around 8 to 12%, and we've already pulled back 5%, then you're pretty safe statistically to sell some put spreads or sell some puts or get some long directional exposure in there. As always, use stops, use position size, manage your risk, and so on, but that's a good place to get started. Mike's asking, do you always take let me see it. Do you always trade a credit spread from the tops, or would you consider a diagonal or calendar that might benefit from rising implied volatility from the tops? So I wouldn't look at, I would look at calendars. I'm actually long put calendars in the Qs right now. I'm long put calendars in Apple. I'm long put calendars in Wayfair and Overstock. I think I converted Overstock to a put vertical spread. Right now, it's very difficult to be long options straight up on NASDAQ stocks, because what we are seeing, if you look at VXN, what we are seeing right now is that implied volatility is rising as the market's rising. Do we have time to riff on this really quick? I'm not sure, because I know I came in late.
Yeah, you have a couple minutes left.
All right, cool. Let me just pull up the slides. Oh, there's the put calendar we took. So that's what it looks like. But I want to look just really quick. You can look at this on YouTube, but you're going to get a little bonus video right here. Basically what's happening is the same mechanics that caused the squeeze in Tesla back in early 2020 are the same mechanics that's going on in all large cap NASDAQ stocks. Way too many people are buying calls, and the call buying size is so large that it's dwarfing the overall liquidity and volume involved in NASDAQ stocks. That's one of the reasons that we're seeing NASDAQ stocks run higher, and implied volatility is also going higher. So, some examples right now. Apple's rallying, and it has an implied volatility in the 50 percentage point range. I mean, that's insane, right? You have a very well-run company hitting all-time highs. The realized volatility is not that high, and we have implied volatility at 50%, all right? And that is because there are no market makers left to take the other side of the long call trade. And so implied volatility has to explode. At some point that will give. Once implied volatility gets high enough, to sort of cushion the kinds of rallies we're seeing, you'll probably see a rug pull in tech. Okay, and that's what I'm looking for right now. All right, Jennifer's asking, how do you use the expected move to find the option pricing? I don't. I do sometimes, but that's kind of beyond the scope of what we're talking about. So to Jennifer's point, to find the expected move as being priced in the options market, you can look at the straddles, you can look at the price over strike on the straddles, you can look at the delta on each individual option, right? So a 30 delta option is about 1 standard deviation away. I like to start around 20 deltas if I want to do credit spreads and focus on the short side. There was one more thing I wanted to talk about before we went on, but I think that's about it. So the other problem that we have is that my site's still down. So I think that's about it. Cool. Are there any more other questions? I know we kind of did a very, very quick look at everything. And I do have a course on this. It's $7. It's available. I just don't know how to get access to it because
you want to give them your,
down.
Do you want to give them your email address?
Yeah, we'll do that. All right. So I'll just put it out there. Shoot me an email if you're interested. And I think that's about it. I thought I had an extra hour. I guess I didn't. I hope you all got a lot of very condensed information out of this. The Turning Point Indicator is free on TradingView. If you want it on Thinkorswim, I have it somewhere. But you can email me, and then I'll give you the link that you can directly import the indicator into your system as well. And I think that's it for me.